Welcome on board Aniruddha Naha, CIO at Alternates PGIM Asset Management as well. Thanks, Aniruddha. Good speaking with you today. First up, let's try and understand the market setup because we've been going on from strength to strength. There is that gush of liquidity, especially domestic liquidity, which is supporting the market. But of late, there has been this trend that large caps and the frontline index has been doing better, and the broader markets have been a bit of an underperformer. In fact, the likes of banks, etc., have made a bit of a catch up. Do you think a churn is underway and now the next 12 months would perhaps belong to quality and large caps and not really momentum?
Yeah. Good morning. Thank you for having me here. We clearly believe that there is a bit of a slowdown in earnings which has happened in the last quarter, and this current quarter would also see some amount of slowdown. Having said that, from a valuations perspective, clearly the quality end of the market and to a certain extent the large cap segment still offers reasonable amount of comfort in terms of valuations. Uh, we are hoping that post monsoons, you would start seeing earnings coming back. It will be a little more broad based, and that should drive the next leg of markets probably a couple of quarters down the line.
Capex seems to be one of the key themes of your investment thesis here, but if you look at the government Capex, that has slowed down. In fact, it's down around 18% from for FY25 so far, and private Capex has not picked up meaningfully. So what are those green shoot areas that you're seeing on the back of which you're so much bullish on Capex picking up going forward?
Sure. See, this year, financial year, we also saw, the election results, etc. There was a reasonable amount of slowdown that happened. The monsoons have been strong this year vis-a-vis last year. So to that extent, also the capex activity comes up purely because of monsoons. The way we look ahead, I think the government's focus on the investment cycle pickup will continue. There is absolutely no two ways about it. I think incrementally also the kind of spends that we are seeing or the allocations going towards, let's say, defense, railways, and other capex oriented cycles, the renewable part of it. I think this will continue. More interestingly, what we really like about the private sector side is the balance sheets are very deleveraged today. We've looked at the NSE 500 odd companies and beyond also. We haven't seen such a clean balance sheet for corporate India for a very long period of time. That is one. And the second thing that we observe is the capacity utilization has definitely picked up across corporate India. Today, for the first time, probably we've gone beyond 75% capacity utilization across the NSE 500 and sector wise. There are segments in the market where it's beyond 80%. So you've got clean balance sheets and capacity utilization picking up purely from a demand perspective. And if that happens, we are reasonably sanguine over a period of next 2-3 years. You will see the private sector capex side picking up. In fact, across sectors, whether it is cement, electronic goods, cap goods, pharma, textiles, logistic, chemicals, and a few more, we are seeing specifically, maybe not at a broad-based sector level, but company-specific levels. We are clearly seeing companies going ahead and spending for the next 3-5 years.
Okay, so there is company level spend and capex is picking up. But Anirudh, just wanted to get a sense from you, given the fact in your earlier answer you pointed to the fact that Q2 can perhaps see some further slowdown in earnings. Q1 as it is wasn't great. The valuations of the Indian markets are really punchy, what, 22, 23 times in terms of the forward earnings. What do you then think is the best strategy right now in terms of the portfolio allocation, as well as what the realistic expectation should be there for the rest of the next 6 to 12 months from the markets?
Sure. I think that's a very valid question. What we are clearly saying is we have probably upfronted a bit of returns in that sense. This year, FY25 will be a year where we have suggested to investors to take it as a year where you build portfolios. Do not expect too much of returns over the next 6 months or 6 odd months or this till end of financial year. I think the next financial year onwards, once we start seeing numbers come through in the December odd quarter, I think that is where probably the earnings will get or the valuations will get justified by followed on earnings which come through. So over the next 2, 3, 5 years, will Indian equity markets deliver strong returns? We are absolutely positive on that. I think this will be a year of consolidation where earnings need to catch up and justify where valuations are. Otherwise, what will happen is the markets could go through some amount of time correction. And what we are seeing presently, for whatever the markets are returning, it is largely expansion and valuations rather than earnings picking up. We always like to invest into segments where we are clearly seeing earnings picking up, and that is something that we are tracking very closely as of now. NSE 500, it went ahead and delivered an earnings of less than 10%, and that has been a little bit of a disappointment, frankly speaking, for the markets.
Given that FOMC outcome will be out today, and rate cut is something which is pretty much expected by everyone on the street, and Indian RBI is also expected to follow suit. We don't know when, but it will as the street expectations are. So for say short term, which are those sectors that you're parking your money in, and which are those sectors that you're avoiding for now?
Sure. I think so. The NBFC segment is something that we are positive on. The large cap, good names out there, and which have got a reasonable long track record of being listed. So we are definitely betting our money out there. That is one. But please understand, India generally across, the corporate side and even at a personal level, Indian individuals, they do not carry too much of debt on the balance sheets, individual balance sheet, whether it's the corporate balance sheet or the individual balance sheets. So to that extent, if you have a rate cut, it actually doesn't feed in too much into the a reduction in the interest cost. So to that extent, probably if we have to bet on one sector, that would be the NBFC sector, where the cost of funds would definitely start coming off. But generally across any sector or any company which has reasonable amount of leverage would be stand out to be a beneficiary, because you would see interest costs come down in those segments or those companies.
Aniruddha, good chatting with you. Thanks so much for making time and speaking with us. So that's a
If you like this video, then like, share and subscribe to ET Now.